The Treasury buyback program. What does this have to do with liquidity in the Treasury market? And does this really matter for you and me? Hello, members, super savers, and bond course fans. I hope you're having a good week. We're talking about the Treasury's recently announced buyback program. And specifically, here are the 3 topics that we'll be covering in today's video. 1. Why is the Treasury launching a new buyback program? And how will it work? 2. Where does the Treasury get the money to fund this new buyback program? 3. How did the first buyback go? And what impact will the Treasury buyback program have on you and me? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. As many of you have heard me say before, as a general category, Treasuries are considered to be the most liquid fixed income investments in the world. In financial speak, this means that if you want to sell your Treasury bills, notes, or bonds, even as an individual bond investor, like in our community here, you will usually be able to find a willing buyer at a reasonable price within a reasonable timeline during regular trading hours, which for all practical purposes means almost instantaneously for most Treasuries that are normally issued at very high volumes. Now, the Treasury is interested in maintaining liquidity in the market because this helps with finding buyers. Let's take you and me, for example. Even if our general plan is to buy and hold to maturity, it doesn't hurt to know that if we ever needed to sell our T-bill, T-note, or T-bond, we would be able to do so relatively quickly and at a reasonable price. Higher liquidity also helps the Treasury to keep interest rates down a bit on the margins. However, as those of you who are on our email list already know from our free Bond Bites video series, and specifically from Bond Bite number 4, while Treasuries as an overall category are generally liquid, there are some pockets in the Treasury market that are less so. For example, TIPS, Treasury Inflation Protected Securities, and the 20-year T-bond. And that is what the recently announced buyback program is trying to address. Some pockets with less liquidity within the Treasury universe. And this explicitly includes TIPS. Let's walk through a summary of the Treasury's tentative quarterly buyback schedule. Every week, starting this week, through to the end of July, the Treasury will buy back up to 20 CUSIPs. Each operation is a term the Treasury uses to refer to a buyback. So each operation will have a maximum purchase amount of either $2 billion for nominal coupon securities, meaning T-notes and T-bonds with coupons, not Treasury zeros or T-bills, or $500 million in TIPS. The combined total of these buybacks over this period, this quarter, is $15 billion, or about 0.06% of the Treasury's outstanding. At some point, the Treasury may move this $15 billion of quarterly buybacks to $30 billion. But even $30 billion would represent only about a bit more than 0.1% of all Treasuries outstanding. So, we do not expect that the Treasury buyback program in its current form to have a significant impact on the overall market. More on this towards the end of this video when we talk about the impact of the Treasury buyback program on you and me. Having said that, the Treasury buyback program may help the liquidity of the selected CUSIPs that will actually be bought back, namely these 20 here per operation that are being targeted. More on this later as well, though. Now, the 20 bond issues that the Treasury will buy back, the 20 CUSIPs here, they will actually only be published on the announcement day here and subject to change until the morning of the operation day here. Any bonds that the Treasury buys back will be retired, meaning canceled upon settlement. So, now that you know why the Treasury is launching a new buyback program to support pockets with less liquidity, such as TIPS, and you know how the new buyback program will work, let's move on to the next section of our video. I think that on this channel, most of us are well aware of our country's growing budget deficit. and the sheer volume of U.S. Treasuries that are issued on a weekly basis. So it should come as no surprise to you that the Treasury is buying back old debt with money it gets from issuing new debt. For example, the Treasury could issue more liquid 10-year T-notes to buy back some less liquid TIPS. This has the effect of shifting debt into more liquid securities. But whether this will actually reduce the overall debt outstanding remains to be seen. More on this shortly. And be sure to check out this video here on one of our bond courses if you're interested in learning more about investing in U.S. Treasuries, the difference between 10-year T-notes and 10-year TIPS, and how to build a bond portfolio. Back to Treasury buybacks though. If we look at the history of U.S. Treasury buybacks between 2000 to 2002, the Treasury ran a larger buyback program that did actually reduce the nation's debt. But this was at a time when the federal government was running a budget surplus. Between 2003 and 2013, there were no buybacks. And between 2014 and 2023, there were some small value buybacks to maintain operational readiness, meaning to test the waters and make sure the process was working. But the amounts were not significant. And now in 2024, here we are currently with the new buyback program that started this week. We'll have to wait to see how this will evolve, whether it will remain a kind of testing the waters like the previous program, just with higher volumes, or whether it will evolve into something much larger and more impactful. It's also currently unclear whether the Treasury will make money on these buyback operations. On the one hand, they may be able to buy back older, longer-dated securities at market price, which should be at a discount to par value for securities with a low coupon, and would therefore reduce the overall debt of the U.S. government. On the other hand, the new debt they will need to issue to buy back these old bonds will most likely carry a higher coupon and be more expensive, thereby increasing net interest expense and the budget deficit overall. So these two sides may just cancel each other out. But it's too early to tell at this point, especially since, as I mentioned earlier, the buyback amounts aren't that large relative to the overall debt outstanding. Right. With the background that you now have on the Treasury buyback program, let's move to the top of mind question that many of you have sent our way, and the next section of this video. Now, it seems there's a bit of speculation out there on social media on whether these buyback operations are a harbinger of a larger liquidity crisis to come for Treasuries. Some even suggest that we're already at the beginning of a severe liquidity crisis. We just can't see it yet. Not sure how this would work, but in any case, the Treasury explicitly states that the current buyback is a liquidity support buyback. Liquidity support buybacks are intended to bolster market liquidity by establishing a regular and predictable opportunity for market participants to sell off-the-run Treasury securities. Off-the-run Treasury securities include everything except the most recent offering of a given maturity, meaning they include all previously issued bonds that are still outstanding and are generally slightly less liquid and less frequently traded than the newest or on-the-run Treasuries. The Treasury also explicitly states that it does not currently intend to use buyback operations to mitigate episodes of acute market stress. That's basically an eloquent way of saying that the Treasury doesn't plan on using buybacks as a mechanism for addressing a severe liquidity crisis. And we agree with what the Treasury says here. These buyback operations, as they are currently announced, are just not designed to address a real overarching liquidity crunch in the Treasury market. And they wouldn't mitigate much during an episode of acute market stress anyway. Let me say this again. The combined total of these buybacks over this period, this quarter, is $15 billion, or about 0.06% of all Treasuries outstanding. And even when the Treasury removes this 20 CUSIP cap per operation and targets $30 billion of buybacks per quarter, that is literally a drop in our overflowing bucket of debt. We issued about $638 billion of T-bills, notes, and bonds this past week alone. Let those numbers sink in. In 1 week alone, we issued about $608 billion more debt than the Treasury plans on buying back eventually in 1 quarter. And that's why, as I mentioned earlier, we do not expect the Treasury buyback program in its current form to have a significant impact on you, me, or the overall market, with or without a severe liquidity crisis. These buyback operations are just too small, never more than $2 billion per week, even less for tips, and they're way too restrictive, 20 CUSIPs per operation, only 1 auction for 1 maturity range per week. The first buyback happened this Wednesday, May 29th, and I would be surprised if anyone in our community really noticed anything out of the ordinary. The market didn't really pay much attention either. This Wall Street Journal article summarizing the day in the markets focused on rising bond yields and the potential impact on stocks, but the article doesn't even mention the buyback. And it was exactly the same over at Bloomberg. Rising Treasury yields made the headline, but the bond buybacks were not even mentioned in the text. Now, for those of you who want to know how the auction went, it was not uninteresting, at least for me. The Treasury spent the full $2 billion they had allocated for this first round of buybacks, but they spent the vast majority of it, 98.25% to be precise, on this single CUSIP here, a 5-year Treasury note that was issued on July 31st, 2020 with a 0.25% coupon, and of which they bought back $1.965 billion at 94.461%. The Treasury had initially issued $49 billion of this bond, so a buyback of almost $2 billion may have helped liquidity here in this single CUSIP. But again, I think that most of us in the community wouldn't have noticed. As for how the buybacks are conducted, the buyback operations will be implemented via the Federal Reserve Bank of New York in a competitive auction process geared towards professional market participants with minimum and incremental order amounts of $1 million in par value, meaning interested participants must submit orders in quantities of $1 million, $2 million, $3 million, and so on. For Diamond NestEgg regulars who are familiar with Treasury direct auctions, this also means that there's no non-competitive process during these buyback operations. So not only will the buyback program have a minimal impact on you, me, and the overall market at this point, most of us retail investors will not even be able to participate directly in the buyback to tender some of the less liquid tips we may own and want to sell. We may, however, still benefit indirectly if, let's say, liquidity for some of these tips will increase after the tips buyback on June 10th and July 9th. Now, if a severe liquidity crisis in the Treasury market did materialize at some point, the Treasury could, in theory, implement a buyback program to inject liquidity into the system. But make no mistake, a buyback program that would be able to mitigate acute market stress, as the Treasury terms it, would have to be at a completely different scale than the one that is currently being conducted. It would need much larger amounts, much more frequent auctions, and a much wider range of CUSIPs, bonds, that would be included. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you did, I'd love to invite you to take a look at this video here on one of our 2 brand new bond courses so that you can take advantage of some of these anticipated higher for longer rates. Or join us in our next live online course and member sessions where we'll be talking about the upcoming auctions and other top-of-mind community topics. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership. And see you again very soon with more brand new wealth-building content for your financial journey.